Hello everyone. Happy March. A quick update on why the markets continue to track higher and what could keep them going. So for one, we've been focused on the economic data. The CPI inflation number for January came in hotter than expected, and that sent the market into a tailspin. However, inline PCE data, which is the Fed's preferred measure, saw the market surge once again, as the market seemed to have adjusted to the idea of 3 rate cuts from the Fed, now starting in the summer. Most analysts don't see inflation coming back here in a big way, and that has lent some credibility to the rally here. More importantly, strong US GDP growth and a very low level of unemployment has led the market to believe that there will not be a recession in the US this year. This may very well be the case, since we've been seeing outsized levels of government spending, and this is an election year. The government may try to keep spending levels elevated in order to gain popularity. The other boost to the markets has obviously been earnings. We've come out of an earnings recession, which is negative earnings growth year on year. Earnings growth now is projected to increase by 10 to 11% for 2024, and the majority of earnings revisions are still coming from big tech companies. Now, many analysts are worried that this looks like the dot-com bubble and that AI is the new bubble. Unlike the dot-com bubble, however, so far we have seen big tech deliver on their promises, whether it's because of AI or higher demand for their products. They have been beating revenue and earnings growth estimates, and this is pushing their stock prices higher. So we ask now, what could keep this stock market rally going? Firstly, yields below 4.5%. We have seen the 10-year yield increase substantially since the beginning of February. However, oddly enough, this has not created the pressure on equities as expected, because of the reasons we just discussed. But we think if yields start to move above 4.5%, that could start to hurt stock prices. Secondly, a weaker US dollar. The US dollar has also been holding firm for the last month or so. However, a weaker US dollar will definitely mean improved earnings for US listed companies, since almost 40% of earnings of the S&P 500 companies comes from overseas. A weaker US dollar will also help global GDP growth. Right now, we have the US posting strong economic growth numbers. A few of the emerging markets, such as India, is also posting strong GDP growth. However, most of the other developed countries still need to catch up. An odd factor here is also inflation. While higher inflation will mean that the Fed may keep rates higher for longer, it also means that we could see revenues and earnings increase for companies, or at least remain positive. Now, these factors will also help the stock rally broaden out. We have been talking about this market marching higher mainly because of a handful of companies, which are the big tech companies. If the rally can broaden out and more companies can join in this rally, we will see a more sustainable price increase for this market. So to recap, we have relatively solid tailwinds driving the market at the moment, solid data, and earnings. If we can see yields stay below 4.5%, a weaker US dollar, improving global growth, and the rally starts to broaden out, this market could certainly march higher during the year. We hope you have enjoyed this brief market update. Please consider subscribing to MacroVisor, where we track macro data on a daily basis and discuss investing strategies that could benefit you.